So the big, beautiful bill, this was passed in Congress not that long ago. And for those that ask me, are you surprised to see this bill passed? Absolutely not. I think we all knew that this bill would be passed because it extends President Trump's tax cuts from his previous term. These tax cuts were set to expire shortly, and the passage of this bill allows those tax cuts to extend, and that is obviously a good thing for the American people. This tax bill also added some other things, such as no tax on tips, something that President Trump campaigned on during his campaign for the presidency. No tax on overtime. We talk a lot about here in Canada how, because of the high tax rates, that all those that are offered to work overtime to receive time and a half for their work. Many people say to me, you know what, Allan, why would I do that? A lot of my overtime pay will just go to taxes. So in the US now, no tax on overtime. That is a very big thing and a very good thing, I think, for business to have people work overtime and want to work overtime. It allows the business to be more efficient. There are also I don't want to say tax cuts, but other tax credits, if you will, or tax breaks. Maybe that's a better way of putting it. If a company now were to purchase, let's say, something for the business, whether it's a new truck or some sort of equipment, they were able to write off that purchase over a period of time, amortize it over a few years. Now, President Trump has allowed for these businesses to actually write off that purchase in the year of the purchase. So it's not something that you would have to amortize over the coming years. You could actually amortize that purchase right then and there. So a lot of positives, in my opinion, pro-business positives from the one big beautiful bill. The one big negative, actually, is obviously the amount of debt that this will bring to the United States, amount of debt, increase in debt levels. I've seen it as much as $4 trillion. We're going to show up a chart shortly that will show as much as $4.5 trillion of I guess, spend, of indebtedness that this tax bill will bring on. But interesting comment out of Scott Bessent. And I think this is something that, here in Canada, we can kind of take a picture or use this as an example for us up here in our country. And what Scott Bessent, Treasury Secretary, said is that, yes, this bill will, I guess, unfortunately, increase the debt levels in the United States, but this is good spend or good debt. And what he meant by that was he believes that the debt that they're adding to their already very large debt levels will bring on growth. And if you are growing faster than you're growing the debt levels, that's actually a good thing. And actually, over time, it'll help to bring down debt levels. So whenever a country borrows money to spur on growth, to increase business activity, that's a positive. And Scott Bessent, Treasury Secretary, said that this is exactly what this bill brings. And so, yes, initially, debt levels will rise, but over time, they will come down as long as the U.S. can make in and around 3% growth, 3% GDP growth per year. Then they believe the growth aspect of that will bring on more revenue to the government and therefore allow them to pay off debt. So I guess grow your way out of debt, which is something that I've heard Premier Ford say as well, and many others in the Conservative Party up here talked about, adding some debt, but growing, pro-growth initiatives. And this is what the Republican Party is all about, pro-growth initiatives. And that's what Scott Bessent, Treasury Secretary, has mentioned recently. Our first chart actually shows some of the effects of the increase in debt. Our first chart is the U.S. 10-year Treasury. We're seeing that the U.S. bond rate, these are Treasury bonds, 4.41 almost. And we're seeing on the far right-hand side of this chart, you can see that the bond rates or bond yields are going higher. Why would they be going higher? Well, perhaps countries are not buying as much of these treasuries, as much of the U.S. debt as they once were. Perhaps they're concerned about rising debt levels. And so if you have rising debt levels, countries aren't maybe as confident in the U.S. economy as perhaps they once were, as confident in the U.S. dollar. And so we start to see countries maybe not buy as much of U.S. debt, and that has pushed up longer term debt. You see here the 10-year Treasury bill, 441 almost. We have a 30-year chart here, again approaching 5%. You can see sometime towards the middle to end of May, you can see that debt levels actually reached above 5%. And we know that these treasuries, they affect many things. One big effect is on mortgage rates. When you see treasury yields move higher, especially the 10-year, both countries, Canada and US, we know that mortgage rates are usually set based off of where the 10-year and maybe even at times the 5-year is trading. Our next chart, a very nice one here, shows the whole world and debt levels all around the world. And you can see here all the different colors. The light green, which would be Canada. Then you can see the percent of GDP, so debt to GDP. And you can see all different countries. The United States is beige, that beige color. So you can see a lot higher debt levels than us here in Canada. Some parts of the world like Asia and Russia, we don't have that information. You can see in South America, I believe that would be Brazil, also high debt levels. And again, this is all about debt. Is it good debt? Is it not so good debt? I relate it to someone who has a mortgage, right? Who maybe can pay off some of the mortgage or all of the mortgage. But if you can get a mortgage rate at 3%, why would you want to pay that off if you can invest that money instead and make a rate of return that could be in the 7 to 10% range if you're in a moderate risk portfolio? So paying off your mortgage at 3% or investing it to make 7%. And that's kind of what Treasury Secretary Bessent has been discussing, or at least alluding to, with taking on this extra debt with this passage of Big Beautiful Bill. Our next chart here, and as I said off the top of the show, we have a lot of illustrations. So let's get to our next chart. And this one kind of says it all. This is how fast and how much US debt levels have gone higher in the last, well, I guess going back to the 70s. And really, since 2020, so the right side of the chart, look how steep that curve is. Very, very steep. It's the steepest it's ever been, which means these debt levels have been going higher for quite some time, but even faster. The debt levels have been increasing even faster in the last 5 or so years. I guess there are a lot of reasons for that, perhaps COVID. I know during the Biden administration, debt levels went up tremendously, and a lot of that spend obviously had to do with COVID. But nonetheless, U.S. is at high debt levels. So when you have high debt levels, who is buying all this debt? Our next chart clearly shows who holds U.S. debt. And it's interesting because for the longest time, the biggest holder of U.S. debt was China. China held by far the most U.S. debt, or lent the most money to the United States. And now you can see that it's not even close. Japan by far buys the most U.S. treasuries, lends the most money to the United States, buys basically is the lender for the United States, buys their treasuries, as I said, in auction. China is now second. And in fact, I've actually seen some recent reports. This one actually is a end of year 2024, but I've seen as recently in the last few months to say that the United Kingdom, the UK, surprisingly enough, is the second largest holder of U.S. debt right now, ahead of China. And if you scroll down a little bit, you can see Canada is in the number 6 spot. So very important for the United States, these countries, to keep buying, obviously, the treasuries, keep buying the bonds that the U.S. is offering, so the U.S. can continue to borrow to fund all the things that it wants and needs to do. Our next chart shows U.S. GDP. And you can see here that first quarter GDP showed an actual negative number, first time in a long time. And no matter how great President of the United States, President Trump, says things are going, if we see another negative number in the next few weeks after the second quarter number, that is a negative number, then you will see and you will hear that the U.S. is officially in a recession. 2 negative quarters of GDP back to back, and a country falls into recession. Now, probably say it would be considered a mild recession, but a recession nonetheless. And getting back to, again, what the Treasury Secretary Scott Bessent said, borrowing to stimulate growth, borrowing to get businesses to spend more, to grow their business. This not only helps bring in more revenue to the government when they grow, when businesses grow, when people grow and make more money, because we know that, especially in the US, when they're making more, then they're spending more. The consumer drives the economy in the US, makes up about 70% of it. So borrowing money, the hope is that, at least from the Trump administration, people will spend more, businesses will spend more, drive GDP higher. And as you can see in the United States right now, GDP needs to move higher. Our next chart, estimated increases in savings in US federal spending from the bill. So here I alluded to off top of the show, tax cut extensions cost in and around 4 trillion, 4.5 trillion, have some defense spending, some border spending with the border wall. Total savings, there's going to be cuts to Medicaid, 930 billion. The green energy, all these incentives from buying, for going green, buying a green car, for example, electric vehicle, food benefits reductions, 287 billion. Green initiatives, 488 billion. Adds up to somewhere around $1.5 trillion, maybe 1.7 trillion. But you can see that the tax cuts are going to be a lot more than that. And that is the worry. And that is why you're hearing and seeing perhaps countries maybe moving a little bit further away from US treasuries. You're hearing people concerned about the big spend. And you hear government talking about they're going to bring in money from tariffs. They're going to bring money in from growth. And that's what they're going to use primarily to offset a lot of the debt levels that obviously are increasing. Last but not least for this segment, our final chart, which is the GOP budget is unpopular, and every poll asking about it. And on the left-hand side, you can see all the pollsters. And on the right-hand side, you can see how many oppose versus support. So kind of makes you wonder if the people are behind this bill, the one big beautiful bill. I'm a little surprised to see that data, I have to say, because people have to know that if this bill didn't pass, their taxes were going to go up significantly on many Americans. So a little bit surprised by this poll, but it just goes to show you that it's not so cut and dry. It's not so easy. And we're going to hear a lot about what the current administration has done and is going to do over the next year as we get closer to the midterms, to the primary elections, to the midterm elections come November 26. We'll see what happens between now and then, but that's going to go a long way for all of us to see whether or not the Republicans will continue to hold the majority in both the Senate and the House and allow the president to continue doing what he's doing now, adding his new big beautiful bill and continue with his increase in tariffs on major countries.